following announcement has been paid for by the
Wealth Management Advisory Club. Hey everybody, it's the president of the Wealth Management Advisory Club, Jack Mitchell here. Welcome back to another exciting WMA Club meet. Before I set you guys off, this is awesome you guys about to watch today. A couple announcements on our end, as always. All right, so a couple announcements on our end. First off, we have added 2 more bonus events to our schedule. Obviously, we're going to go over those right now. So, hold on a second. All right, there we go. Okay, so on Sunday, April 30th, WMA Club at FDU Admissions will be collaborating an event for Go FDU Day. Obviously, this is their National Decisions Day event for FDU admitted students. Obviously, it will be held at 10 a.m. in the Student Center Mall on the former campus. Obviously, Metro members, you guys want to come, the more, the merrier. Cannot wait to see all you guys who are admitted students to FDU coming in the fall. We cannot wait to meet you. You'll be able to see me, the rest of my e-board. I'll be super excited to see you guys, so be a fun day. Obviously, 10 a.m. to 2 p.m. And then on the 4th, May 4th, actually, May 4th will be very special because not only will be our last meeting of the semester, but also will be FDU Silverman's recognition event. Yes, it'll be a bonus event that we are going to be, persuading our members to go to. Now, I have no idea what the time is for that event. So again, if you do need to find out where that is, go to the FDU Silverman page because I have no idea what the time is. Most likely it'll be held in Lenfield Hall. Most likely. I don't know. I might be wrong about that, but if I am right, yay. If not, then, then oops. So that will be May 4th in Lenfield Hall on the Forum Campus. Metro, I know you guys have your own event over at Metro. When we find out about that, we will let you know, and we'll put that on our schedule. All right. So that's one. The second thing, we'll be adding another event, which will actually be after the semester's over, but I'm not going to reveal it just yet because it's actually going to be part of our major announcement in next week. So, again, stay tuned for that. Let's see. What else do we got here? Oh, yeah. So the remainder of the week, let's go over that. So the remainder of the week, obviously today, we have the AFC meeting, so obviously the American FinTech Council meeting. Then tomorrow is the BAP New Sigma Chapter Elections Watch Party. Yeah, I know. It's the second one we're doing. Because the first time, things didn't go the way, we were hoping it would go. But thankfully, this time around, it will go the way we were hoping. So it will be tomorrow in the Joyful Room, where I am in right now, room 113 on the Florida campus, on the Monitor Center for Metro members virtually via Zoom, 2:30 to 5:30 p.m. Watch as you remember the root on yours truly running for BAP New Sigma Chapter President and our VP, Gloria Petruska, running for BAP New Sigma VP. Metro members, guys want to come in person, the more the merrier. The door's wide open. Please come and enjoy an awesome day with us. And then Thursday, will Barrister Wealth come in. Charles C. Weeks Jr., who's also CFP certified, will come to speak to us in the mansion, room 12, Dickinson Hall, room 104, Zoom and WMA Club socials as well. So, yeah, that's how the week's going to go. And then also, that's the week's going to go. I'm sorry. I've had a bunch of things going around my head today. I apologize. Finally, it is time to feature our sponsors. Yes, our corporate sponsors that we're going to do every single meeting. So, this week's meeting is sponsored by our good friends over at First Card. Are you a student tired of using outdated payment methods that don't fit your lifestyle? Look no further than First Card Inc., the student debit card that revolves around you. Yeah, we're talking about you guys, the students. With First Card, you will have a payment method designed specifically for your needs as a student, more specifically a college student. The card is packed with features that will make your life easier, such as easy online banking and budgeting tools to help you stay on track with your finances. But First Card doesn't stop at practically just that. They also know that being a student is about more than just about studying, coming to clubs, coming to WMA meetings, and paying bills. That's why their card offers exclusive rewards and perks tailored to your interests, from discounts at your favorite local shops to special access to events on campus. And with First Card, you can rest easy knowing that your money is safe and secure. Their advanced security features enables your information and funds are protected at all times, giving you one less thing to worry about. So why settle for boring, outdated payment method? Join the First Card community today and start earning the benefits of a student debit card that truly revolves around you. So, click the link down below on our link tree, go to our website, click the sponsor page, click that link. You'll be able to sign up for a free First Card account. Thanks to us here at the WMA Club, and thanks to our sponsors, First card. Again, like the first card for today's sponsors today's meeting. Now, again, I do know that on the original schedule, we did have Cross River, but actually, just to backtrack with this, we were supposed to have them come in, and then we found out that our speaker is coming to speak to you guys today actually changed roles. He's now the new CEO of the American FinTech Council. So obviously, that is who we're going to get today. I do apologize. We were supposed to get Cross River to come in, but I do promise you guys, next semester, we will bring in Cross River. I do promise you guys that I will bring him in next semester. Again, this just happened to us like literally 2 weeks before the meeting happened. I didn't want to cancel. So again, I do apologize on that end, but I do promise you guys, you hold my word for it, that next semester we'll have Cross River. But we are super excited to have Phil Goldfeder come and speak to us today. Obviously, again, I probably said in the meeting, but from all of us here at WMA Club and from your e-board and yours truly, we want to congratulate you, Phil, on becoming the brand new CEO of the American FinTech Council. We hope you best of luck in your future endeavors over there. So, with that out of the way, if you guys are ready, I know I mostly am ready. Let's get you guys off to the meeting.
And now, our feature presentation.
Here. Hello, everybody. Welcome back to another Wealth Management Advisory Club meeting. I do apologize for the late start time. However, we do have our speaker here today, Phil Goldfeder, over at Cross River formerly, but now we just found out today that he's been appointed the new CEO of American FinTech Council. I just want to read a little bit about him, and then we are going to let him get on underway. So, with an extensive experience across both the public and private sectors, Phil has been a highly respected figure in the world of finance and fintech, advocate for financial inclusion and growth in communities across the country. Phil was the former Senior Vice President of Public Affairs at Cross River Bank, a leading financial institution that provides innovative banking and technology solutions. In this role, Phil spearheads the development and execution of strategic initiatives aimed at fostering strong relationships with the government and community stakeholders. And recently, he's been appointed, like I said earlier in the introduction, the new CEO of AFC, which is the American FinTech Council. Before joining Cross River Bank, he has a successful career in public service, representing the 23rd District in the New York State Assembly. As an Assembly member, Phil demonstrated a steadfast commitment to his constituents and authored transformative banking and insurance moderation and legislation. His dedication to public service also led him to serve as senior advisor to the Senate Majority Leader Chuck Schumer and New York City Mayor Michael Bloomberg. Phil's wealth of experience in leadership, crisis management, and developing deep relationships with diverse leaders has positioned him at the forefront of innovation in the financial and technology sectors. He is an actively industry leader, engaging with policymakers and regulators, and is frequently invited to share his insights at panels, roundtables, and conferences all around the globe. And with that being said, just from all of us here at WMA Club, I want to congratulate you becoming the new CEO of AFC. Congratulations on that. And with that, guys, that's it for me. I was asked a lot of questions. I have a lot of fun with this meeting. And with that, I'm gonna let you take it away, Phil. She's. I forgot. I had a presentation ready.
What did you say? No.
You're presenting from here. So the camera goes through here. So obviously we do have a Metro campus. So the Metro members are able to see virtually via Zoom. So basically,
You want him to look where?
Right there. I'm so sorry. I've been all over the place today, so I do apologize.
Yeah. Okay. You good?
Yep, we're good.
Sure?
Yep, sure.
Okay. I'll do my pocket to distract me. So thank you for the opportunity. It's funny, telling people today that was going to Bailey Dickinson, probably about 3 months ago, wouldn't have had the same meeting. I can't look up there, it's just not.
It's not happening. I was trying to figure out if I should just stand so you can look at me as if I'm standing.
No, this is good.
This is fine?
This is totally fine. And so 3 months ago, probably would not have had the same meeting. However, given sort of the basketball stature of Fairleigh Dickinson and FDU, the idea and the concept of telling people that I was going to FDU tonight actually got me oohs and ahs. And so you should all feel very, very proud. You should have felt proud long before that as students, and we keep working advantage of the amazing educational opportunities here in New Jersey, this has given you a little bit sort of more widespread notoriety. You should be very proud of it, because with that comes other opportunities to sort of, like I said, sort of in the halls of government, it takes on a whole different meaning, even though, like I said, it shouldn't. It shouldn't be anything, but it does, and so enjoy it while it lasts. And so with that, I'm excited to be here. I'm excited always to sort of present to students. It used to be about public service, and now it's more of a combination of my public service combined with the work that I'm doing in FinTech. And so let me start right there, that the work that I'm doing in FinTech is really an extension of my public service. Because when you think about what FinTech is, FinTech, financial technology, is the extension of credit and financial services accessibility to people who need that access. And so today, unfortunately, while traditional banks and financial institutions continue to exit the system and exit communities, particularly minority and rural communities, that is where FinTech started and created and stepped in to fill the void. FinTech is probably created and founded, but began immediately post the Great Recession in 2010, when big banks and banks in general were de-risking, right? They didn't want to lend, they didn't want to provide financial services, they were nervous about the crisis, they were nervous about the regulatory structure. And so there's two big companies that kind of started this. There's two companies, one was called Prosper, one was called Lending Club, and they were probably the founders of the concept of online lending. Also, so there's an evolution of the internet where people were starting to get a bit more comfortable with the concept of, can I do and transact and do my financial services in an online forum? So those are the two companies that started. They were the founding kind of lending companies. At the time, it was called peer-to-peer lending. Today, it's called marketplace lending. And the idea was very, very simple, is that if you can't get access to a bank because banks don't want to lend or don't want to provide financial services, or don't want to give you the time of day, there is now an alternative. And this idea continued to evolve and evolve and evolve and evolve and evolve to where we are today, where I would argue there's probably more people transacting financial services online than they're doing in traditional financial institutions. When you think about how many community banks there were in the U.S. 40 years ago, you're probably talking about 30 or 40,000. Today, community banks across the U.S., there's probably less than 5,000. I think the number today is about 4,700 and change. And you're seeing more and more and more consolidation. And I say this to the New Jersey Bankers Association, and I say this to every bankers association that I meet with. Community banks who do not find ways to innovate are going to die, right? Because at the end of the day, there's a lot of things that you rely on a bank for, but consumers no longer want to access banks on bank terms. They want to access banks and financial services in their own terms. And that's why you hear, if you're listening to the radio, if you're watching TV, you hear all the time that we don't keep bankers' hours. The concept of we all have to shift our lives to work around the 9 to 3 hours of a banker versus today, every bank is trying to meet consumers where they are. Now, that poses a whole different set of challenges. So let's talk about what that all means, right? Because it's not just about lending or opening a savings account, right? This is a wealth management club. And so there's also investing tools and other programs that people take advantage of in terms of things like, without getting into the nitty gritty of all of them, but you have like the Robin Hoods of the world, that people like to buy and sell and trade stocks. You have companies like Acorns that merges with your bank accounts to do roundups that merge into retirement accounts. You have companies, neobanks like Chime, that sort of partner with banks to provide a front end. And then you have various forms of lending companies. You have companies like Affirm, if you want to finance a Peloton, finance a couch at Wayfair, or go online to Amazon and finance your purchase at the end. You have companies like Affirm. And then you have what we call earned wage access companies, right? If the concept of why do we get our paychecks on the 1st and the 15th of the month? The reason for that is because it used to be very expensive to run payroll. As a matter of fact, it used to be people only got paid once a month because it was expensive to run payroll. Today, in today's day and age, why do we still hold to the arbitrary 1st and 15th, or some people just on the end of the month? Why can't I get paid every single day for the money I earned that day? And so there are companies like Daily Pay that does exactly that. It provides that access, and here's the best part, and you don't have to, I mean, let me just be clear, and be very mindful how I say this. You always have to be careful of who you interact with and the companies that you're utilizing online. However, there are good, responsible, transparent companies in every sector that are looking to provide financial services to you and fill the void, or unfortunately, or fortunately for them, traditional banks are simply just not servicing. So that is sort of the large foundation. The American FinTech Council, which I joined about 6 weeks ago, as their new CEO, is a group of those responsible companies across those various verticals. So in the lending, in the investing, in the neobanks, and the banks that are innovating, the American FinTech Council represents them, and these are companies that that believe in a standard. What I mean by that is that we're not trying to reinvent the wheel. It's quite honestly, we're trying to do two things. We're trying to merge the trust and reliability that you expect from a bank with the technology and offerings that the companies offer, and merge together so that when you go and you conduct business, or you trade on Robinhood, or you put your money into a Chime account, you want to feel safe that it is secure, that it is, whether it's FDIC insured, that they're following all the rules, and they're creating a system with structure that people can feel good about. So let's talk about sort of the challenges with that. Right? The challenges with that is that there's a new way to think about our finance. And I say that usually when I'm talking about financial literacy classes, sort of the theme. But now that we're in New Jersey, so let me ask a very simple question. What's the reason why casinos use poker chips? Right? Does anybody have a question like, why are we using chips? Why not just pull out a wad of $100 bills and play poker, or play blackjack, or play cards that way? Why do we have to use poker chips? The reason is because once upon a time, somebody realized that if you're using dollar bills, that you're focused and your brain is telling you that there is value that you are losing. However, if you're using a poker chip, it's a piece of clay, it lowers your inhibition, and you're more likely to spend it, or to bet it, or to gamble it on a poker game. Financial services, unfortunately, is not too different. When you think about how we manage our money, when you used to, I remember as a kid, when I wanted to save, the dollars meant something to me. So I would stockpile the dollars, and the idea of putting it into a bank account was scary to me because I wanted to make sure that I'm saving my money. Today, it's so much easier to spend your money. Most people don't want to hold on to dollars, right? And I say this when there's a room full of people. I usually ask people, how many of you actually have cash on you, right? Like, how many of you are carrying dollar bills? And generally, depending on the age of the class I'm talking to, the answer is dependent, right? So the older the class, the more people have. But generally, there's always people who, at least, even when I'm talking in senior centers, do not carry dollars anymore. Kids today that are probably in college and below are not carrying any. And quite frankly, for me personally, I do the same thing. I don't carry any dollar bills. And the truth is, I'm probably aging myself, because most people don't even carry cards anymore. Every one of these same cards is accessible on my phone, and so there's really no reason for me to do it. But here's the challenge, right? And here's the inherent challenge. It's the same way that you would throw down a $100 chip on the table faster than you would throw down a $100 bill. You're more likely to swipe your phone or swipe your credit card on an app than you would drop down cash to buy that same purchase. You're more likely to want to finance something even though you can't afford it, whereas historically, if you didn't have the cash, you're less likely to do it. There's an inherent problem with that because we've lowered our inhibition, and the idea and the concept of value of money is different. So think about this. For those of you who watch Shark Tank, there was an app that once presented, I forget the name of the company, I don't know their name. The entire concept of the company was that it built in a delay from when you push send on the text message until the text message sent. And the idea with that is we oftentimes send messages in anger, and it built in some time so you could pull it back before the message goes out. Now think about financial services. Once upon a time, in order for you to trade stocks, or to buy a stock, or to sell a stock, there was a process, right? There was a long process, and at any part along the way in that process, You could reevaluate, you could rethink, you could second think, you could, today, right, that doesn't exist. A friend of yours says, oh, I heard a great tip. 35 seconds later, you can go to your E-Trade account and your Robinhood account. You can even, by the way, the traditional banks are starting to catch up. You can go to Chase has an instant account now. You can go and you can trade stock instantly. And so what does that mean? It means there's opportunity for sure. Someone gives you a great tip, you want to get in on it right now, let's go do it, let's go buy that stock. But think about the other side of that, right? Did you actually vet it? Did you have those opportunities to sort of backstop, like, is this a good idea? Well, I gotta get on the phone, I gotta call a stockbroker, I gotta go to my traditional, walk into my financial advisor's office to ask him to move money X, Y, or Z way. Today, you don't have to do that. And so all those fail safes that were in place once upon a time no longer exist. And so it is the evolving nature of financial services that we have to be more mindful of our surroundings. And I would argue, right, if you listen to every sports betting commercial that you hear on the radio, at the end, all the fine print, right? There's 158 warnings they have to give you at the end. I would argue as we continue to evolve and as we continue to use technology and tools, we have to do two things. Number one, we have to be cognizant of our surroundings and what we're using and how we're using it. And to make sure that we're aligning sort of the speed with what we want to do to ensure that we're following the goals that we want to meet, number one. Number two is that we have to understand that there are good actors and there are bad actors, right? And there are good companies and there are bad companies. And I keep mentioning Robinhood because I think that some people find value in their service, but we all saw when Robinhood stopped trading on certain stocks for whatever reason, right? Without going down that rabbit hole, what happened and how it all took place. We have to be cognizant of how we're transacting, where we're transacting, and the companies that we are transacting with. And you have to look, and I make it a practice of mine, whenever I'm looking at an app, I want to look a little deeper than just the flashy front end, right? Who is behind the app? Who is actually making the trade? How does it work, right? How is Robinhood actually able to do what they're doing? How often are these transactions getting settled? What is how is that company making money, right? Are they making money on the fees? Are they taking a cut of my profit? All those questions are critically important for you to ask, because when you do that, you can feel safer about your ability, desire to continue to utilize these services or these tools to build your wealth, to manage your money, and so on and so forth. And so I make it a point to always look at the fine print. Now that sounds silly because who looks at the fine print? Today, more than ever, it's critically important to look at the fine print because in my old world, right, my old job, 7 weeks ago, I worked for a bank, Cross River, which was a state-regulated FDIC insured bank that powers a lot of the apps that I just talked about. They are the backing behind it. So when I look at an app and I go down to the fine print and I see a bank like Cross River, or I see a bank like Lincoln Savings Bank, or I see a bank like Bancorp, or I see sort of about a dozen or two dozen other banks that are providing these services, it gives me a little bit of assurance that, okay, that's the first question I need to answer. There is a bank. And so, as an example, when I deposit $250,000 into my Chime bank account, Chime is not a real bank, but they partner with a company called Bancorp. That is a real bank. Then I know it is direct. I know it is insured up to $250,000. If I deposit my money into SoFi, also, right? SoFi actually offers a service. They partner with 5 banks, and they allow you to insure I think today, they allow you to insure up to $1.25 million because they're taking your money and they're dispersing it amongst many banks, which enable you to get additional insurance. And so, again, utilizing technology to give you even more protection, but you as a consumer have a responsibility to understand the community banks and the technology companies that you're working with, and understand societal changes that things are changing so rapidly. We have to be cognizant of this is real money. These are real dollars. This is real. You're taking real risks, and it's critically important to know what fail safes are there in place. So, as an example of that, when Venmo was first introduced, right, it was the coolest thing in the world. You link your bank account and you can move money, and it was it was called real time. For those in the banking world, you know, it's not actually real time, but you know, it's sort of somebody's taking a risk, but it was almost real time. And then more and more payments companies and different competitors, and there was Cash App and then Zelle through Chase and multiple other banks sort of presented other opportunities. And so what happens, right? Someone says, hey, you owe me $100. Oh, give me your phone number. I'll take care of it, and I'll Zelle you the money, or I'll send you the money, or an email address. You enter that into the app, and whoops, you forgot, you left out a letter, or you entered the wrong digit. So what happens? You've moved the money. With technology, when there is a 3-day delay, right? And so historically, there's a 3-day delay, and when you push send and the money actually moves from bank to bank, there was a 3-day delay. So there was some safety built in that you could stop that mid-process. Again, there's nuance to that, but there's some safety built in. Today, right, just a few years later, right, is what we call the real-time payments network. Real time. When you push money from my account to your account, it is instantly out of my account and is now in your account. So what happens when you put the wrong phone number in, or the wrong email, right? Let's say you're moving money to even if you're using the old traditional sources, you're sending money to a money manager, right? What happens if you put the wrong account number, or the wrong digit in the phone number, and you send the money? Now you send the money to somebody who, again, on these apps, you don't have to ask money. There's no, it is essentially you send it and the money is sent, period, end of story. The money's gone. And so now fraudsters are trying to do this. There's no way to get it back. There's no pullback anymore. And so fraudsters take advantage of that. Now, if you go today to Venmo or Zelle, anyone uses that, there's a double check that they have built in. If you look at the apps, are you sure you want to send money to Steve L at this number, right? There's an app, there's a built-in. If you ignore that, right? And by the way, over time, people will start to ignore that, right? When it first comes, you're cognizant. Over time, you become desensitized, which goes back to exactly what I said. Regardless of how quickly technology changes, you have to be mindful of who you're working with, what companies and apps that you're using. And number two, you have to be cognizant of, forever be cognizant of the surrounding, and what you're doing has real life consequences. So when you move the money and it goes to a fraudster who sent you a link and you send money to a fraudster, money's gone, right? And by the way, banks are being criticized for allowing fraudsters to take advantage. It's unfortunate, but there's not much you can do. So banks, and if you look, again, Chase has built in, Venmo has built in, sort of like that double check. But if you become desensitized to the double check, the money goes out the door. And ultimately, you're gonna have no one to blame but yourself, right? And so it goes back to the age-old, it doesn't matter how much technology you build in, buyer beware, right? Customer beware. We all have our responsibility to ensure that as we continue to think about the evolution of financial technology, the evolution of financial services, and the idea that money in cash is not a thing, right? When I was a kid and I got a $20 bill, I never wanted to let it go. I don't think my kids would know what a $20 bill looks like. It's literally standing in front of them, because it's just not the way we transact anymore. Which means that I have a responsibility to ensure that they understand that what the value of money is, even if they're never actually going to see it in real time. And this is only going to get, like I said, we're all trained and brought up differently, right? Like, it's sort of, my parents still use Facebook. My parents wouldn't dare touch Instagram, right? And, I use Twitter and Instagram, but like, I'm not touching TikTok or whatever the next one is, right? And so there's sort of a generational evolution that continues to happen. Same thing with finance. Same thing with the way we move money, we interact with money, we engage with money. The same thing, the way we think about our financial planning, everything is shifted to a different world. And we have to always be cognizant of that to ensure that our money is safe, that our futures are safe, and that we understand sort of the risks that we take when we invest and move around our money. So with that, I don't know if people are sending any questions. If there are questions, I'm happy to take a couple.
Will do. So first question comes from Sabrina. How has the fintech landscape evolved since you first entered the industry, and where do you see it going in the next 5 to 10 years?
That is a great question. It is very different today than when I entered. So I've been in fintech. As you mentioned earlier, I spent the first half of my career in public service. I served as an elected official. I worked folks like Mike Bloomberg as the mayor and Chuck Schumer. So I spent a lot of time in public service. I came to the FinTech ecosystem about 7 years ago, and it was radically different. Because 7 years ago, and I joke about this all the time, the main newspaper for bankers, and it's not the Wall Street Journal, it's a newspaper called American Banker. And when I first started working at Cross River 7 years ago, maybe once a month, once every other month, there was an article about FinTech. I mean, literally, like every other month, I'd open up and like, oh my God, they're talking about FinTech, and I would forward it to the entire company, like, oh my God, I'm writing a sweet article about FinTech. Because Cross River was sort of new and one of the early adopters of innovation in financial technology. Today, when you read American Banker, every single day, the vast majority of stories about some FinTech company, some crypto company, some online lending company, some payments company. One of them is running afoul of this regulation. One of them has some new niche in their technology stack that enables them to do things differently or quicker. And the challenge is, like I said, is that sort of which one of these companies are real and can you trust, and which ones can't you? Which one are actually stand behind the technology that they're selling, and which ones they can't. And then here's the part we didn't really get into. It's the regulatory structure that surrounds it all, right? I talked about the regulatory structure. I want to bring it back down to human. This is not like, oh, I don't get involved in politics or regulation in Washington or in Trenton or in Albany. But this is not about regulation that like we don't understand. It's about regulation that exists to keep you and your money safe. And so the question becomes, right? If you invest money in Robinhood, is that treated like any other investment company? Like, how does the regulation view that technology innovation? And oftentimes it's not an even match. And a lot of technology companies interpret the regulation differently, right? We believe we could do X like this. We believe we could do X like that. And not everybody agrees. And the biggest challenge for technology companies in the FinTech space, and this has gotten worse and worse over the years since I started, is that the regulatory structure can't keep pace with the innovation. And so innovators want to innovate, but the regulators are not keeping pace with them. And so it creates that constant, not just mismatch amongst the technology companies who have different opinions about how to do what they should be doing, but also sort of you find regulators always playing catch up, and inherently somewhere in the middle, consumers potentially can get harmed. And that's the challenge. And that's why it goes back to what I said earlier, is that gets wider and wider as these technology companies become more and more widely used. And so I'll give you a perfect example, right? Let's just look just quantity of transactions. You know, I remember back in the day when online lending was a few $1 million a year. Today, you're talking about billions of dollars a month that are moving around through online lenders, payments companies. I mean, the number of transactions that are happening in a day in the payments ecosystem we talked about, from millions a year back in 2016 to millions and millions a day today. And so it's really the pace that is continues to get quicker. And the challenge with that is that it's ever evolving, right? So the second you think you have a handle on technology, it's changed. And you have to understand it from the regulator's perspective is that it's just harder and harder to keep up. And so that's why guys like me, like the bank trade associations like the American FinTech Council exist, right? Our job at the American FinTech Council is to try to bridge that gap. Now, the reason I say what I say about responsible, transparent FinTech companies is because, unfortunately, there are bad actors in this world, right? Unfortunately, there are bad companies who are looking to rip you off. Right, those folks are not welcome at the American FinTech Council. Our companies and our members are those members who want to provide financial services to you, the consumer, where you are, but also want to work with the regulator to ensure there's protection. Right, and so it's not, you don't sacrifice one for the other. And again, it's becoming more and more mainstream. If you take a look at the concept of buy now, pay later. Right? The concept of it was once called layaway or credit cards. Today is an entirely different way to access credit when you're at the cash register. And so the question becomes, how is that regulated? How are we treating that? And today I would argue that credit cards are changing their business model to meet the technology company. For those of you who have an American Express card, I don't know who have American Express, American Express, or even your different credit cards are offering pay over time now, right? It's like a new service that instead of just having one credit on your credit card and you pay it, it actually offers you better rates. You click a button and you pay it for installment payment. Traditional credit cards are doing that because buy now, pay later companies are doing that. And it's a better option for you, the consumer. And so credit card companies, traditional ones, are evolving to meet the consumers where they are, like the buy now, pay later industry has. And so the idea is, if you ask me the question, not from when I started to where we are today, I would say if you ask me where we were 2 months ago and where we are today, there's enough of a radical change that we've seen. So it's constantly evolving, and that's kind of where folks like me come in to fill that gap.
Yeah. Next question comes from Emily. In your line of work during the COVID-19 pandemic, what lessons can be learned from the crisis to better prepare the fintech industry for future challenges?
That's a great question. It's a great question because there's no better demonstration of the power and value of fintech than the COVID pandemic. And we tell you 2 reasons why. Number one is the concept of, I do not want to go into a branch to conduct financial service. Right? I don't want to talk to another human. It was COVID, right? We're all stuck at home. So how can I actually continue to transact and conduct my business if I am stuck at home? And so fintech filled that void, right? The concept of contactless payments. That was something that existed before COVID, but blew up during COVID, because the idea of systems where you don't have to talk to someone face to face, but still able to move money in a safe, transparent way was critically important to purchase goods, right? Buy now, pay later companies, right? I'm not going to the store, I'm not using my credit card, so how do I do this? Buy now, pay later. And lending companies actually did better during the pandemic because people were taking advantage of, as an example, right? Peloton sales. Peloton, people were stuck at home, they were looking for a Peloton. Pelotons were selling like hotcakes. People were financing those Pelotons through companies like Affirm, right? And so you actually saw fintech, a demonstration of where fintech can fill a void. If you didn't understand it before, that was one way fintech was filling a void in the market. But even more importantly, fintech stepped up where traditional banks fell on their face. And I'll use an example of small business loans. So the federal government created the CARES Act. That was a stimulus program early on in March of 2020 that the federal government passed. And the purpose of that, one of the programs called the Paycheck Protection Program. For all of you employers that have employees and are unable to pay them now because of business interruption, the Paycheck Protection Program was a mechanism that you get a federal government essentially grant through your employer, and the employer continues to pay your salary, right, for 2.5 months. And the beauty of that was, if the government didn't do that, all those people would just go on unemployment. So this was a mechanism of saving the business, continuing people's paychecks, and continuing the business viability through the pandemic. The challenge was the federal government wasn't offering directly, meaning a business didn't have to go to the federal government and say, hey, can I have a paycheck protection loan? The federal government deputized community banks and banks to make these paycheck protection loans. And so the challenge is that most banks, traditional community banks, are used to engaging with people face to face, collecting information, entering information on pieces of paper, like dealing with and underwriting a loan in a traditional way. The challenge with that is, like, you have millions and millions and millions of small businesses who are looking to access this. Not all of them have bank relationships. Not all of them have a personal banker. And so what do? And so all of those small businesses turn to fintech companies like Rush River, fintech banks like Rush River, who took advantage of the fact that they were a bank. They understood small business lending, but they also understood fintech. And overnight, they created a proprietary application that enabled any small business all across the country to put in an application for a paycheck protection loan. And it was the great democratization of the PPP program. Why? Because everybody had equal access. It didn't matter if you were a big business, it didn't matter if you were a small business, it didn't matter if you were an Uber driver or had a company with 100 employees. It didn't matter. Everybody had the same access as government intended, as the federal government intended. And so, how did it ultimately play out? The biggest bank in the country, Bank of America, made 492,000 small business loans. Like, oh my God, that's a lot. They are the biggest bank in the country. They were able to do that, even though they were doing it manually. They used, and publicly they mentioned it took them 10,000 employees to make that many loans. And most people shake their head like, yeah, that makes sense. You make 500,000 loans, right? And so it makes sense that you need 10,000 employees. Cross River utilized FinTech and made 487,000 loans and did it with 150 people. Okay? And so, I want to be clear about this. The second largest lender of Paycheck Protection Program loans in the entire country, the second largest after Bank of America, was tiny little Cross River. And they did it with 150 employees. Community bank right here in Tina. And so, FinTech is the great equalizer. When you think about the ability for you as a consumer to access financial services, whether you're small, whether you're big, whether you have a lot of money, whether you have a little money, but you want the same treatment, FinTech sort of solves that problem. Not a perfect solution, and it's getting better and better every day. But when you work with the right companies, you work with transparent, responsible companies, you get that access. So those are two good examples of how COVID really, nothing was created new during COVID, but COVID basically sort of shown a very big spotlight on what FinTech could do to solve real world problems.
Great. Next question comes from Melissa. How do you think regulatory framework should adapt to the rapid growth and innovation in the FinTech sector while still ensuring consumer protection?
That's another great question. That's actually the perfect question. The answer is that no one should think that they know better than anybody else. And I say that knowing exactly what I just said, right? No one should think they know better than anyone else. Meaning, you only get sound regulatory structures when you put everybody around the table who has an interest. Meaning, all right, let's think of the federal level now for a minute. I just came from Albany, so we could talk about state government as well, but it's essentially the same idea. Is that when you take a policymaker who is thinking about his constituents and his voters, and then you take industry, who arguably, by the way, is thinking about, let's not be shy, they're thinking about making profit, making money off of their technology or company, and then you take consumer advocates, right, who are interested in protecting consumers at all costs, and then you take some academics who have studies and data, and you take all of those people and you put them around the table to solve one problem at a time. The challenge is you see in Washington, and you see in Trenton here in New Jersey, you see in Albany, and as we're dealing with in Denver, Colorado right now, is that everybody oftentimes thinks they have the answer. And unfortunately, it's usually not the case. Every now and again, you get it right, but it's usually not the case. It's only when you collaborate that you're actually able to accomplish meaningful regulation, policy making. And by the way, that goes across the board. And that's, I spent the whole career in public service, and so I can talk about the idea like how do you pass a bill? You build coalitions, bipartisan, Democrats and Republicans work together to solve a problem. Same thing here. If you actually want to make meaningful difference on a regulatory structure, you engage everybody who's involved. You engage industry, you engage policymakers, you engage academics, you engage consumer groups, and you wait until you found a point where no one's happy. And when you found a point where no one is happy with the solution, that's when you have the right answer. If any one person is more happy than another person in that negotiation or in that conversation, then there's something off balance. Because I think as a capitalist economy and society, you want that business to thrive. Let's be clear, like as us as humans, you want the business to thrive, right? No one says we want business to fail. We want business to thrive. From the consumer group standpoint, yeah, we want every possible consumer protection. We want that consumer to be protected. From the academic's perspective, is you should look at all the data, right? Let's look at the historical context and the data. From the policymaker, right, who understands how to get laws passed, you want to have his input in it. When you put those groups together, I'm sure there's more folks who deserve to be at the table, and so yes, it should be an open umbrella, an open tent. you actually can have sound, rational policy. Unfortunately, in today's day and age, with the polarization of politics as it is, it's usually not the case. And you find sort of one of those groups will push some sort of regulatory structure, or industry will push some sort of regulatory structure. And unfortunately, you end up with a patchwork of just different pieces and regulatory standards that just don't make any sense. And that's kind of, again, kind of where the American FinTech Council comes in. We do our best to bring these folks together as often as possible for rational, sound policymaking. Now, there are other trade associations who don't care. I want to be clear about that. I think that's what makes the American FinTech Council AFC a bit different, is that we believe in setting a standard. Setting a standard means engaging with policymakers, being transparent, working with the community groups. There are those who are just industry companies, industry associations who believe in, we don't care. We believe we should be able to lend X, to X amount rate, right? We want to lend at 158%. Does it matter that the person who's borrowing can't afford it? Do they care? No, that person needs a loan. They're willing to pay 158%. That person, we should be good. I fundamentally, and the American FinTech Council fundamentally disagrees with that. We believe there is a rational, sound interest rate limit, as an example, right? And there's many standards like that that our companies utilize to ensure that we can build the future financial services so that consumers could feel good about the companies they're interacting with, but at the same time, companies can be successful in the ecosystem.
All right, next question comes from our very own board member of our club, Kevin. As the CEO of the American FinTech Council, what are your top priorities for the organization in the coming years?
Survival? No, that's not true. I will say it's quite the opposite. I mean, it's traditional financial institutions that need to be worried. I think it's sound policy, right? I want my member companies to be successful, but every single one of them in some way, shape, or form is exploring and developing a nascent industry. And so I like to take a more thoughtful approach to how do we think about sort of different verticals, right? Some of our verticals are a bit more mature. So as an example, the online lending industry tends to be a bit more mature. As I mentioned earlier, it started way back in 2010, 2011, 2012. So it's been around for 10, 11 years. There's a lot more data about what online lending is doing in terms of providing access to credit. When it comes to buy now, pay later, there's less data, right? And there's less information because that's something that's really been around more prominently only in the last 3 or 4 years. Even less so is earned wage access, right? The idea of being able to earn your wages, in real time. And so every one of those industries, we want to take a bit more of a thoughtful approach, but we want to be aggressive. I want to be clear about what the American FinTech Council is trying to do. We're trying to accomplish something. Meaningful regulatory reforms that benefit consumers and enable companies to be successful. And that's a balance every single time. And so for the American FinTech Council, we're looking and want to solidify the regulatory structures. And the timing couldn't be better. We're looking to solidify regulatory structures today. Unfortunately, there's nothing's happening in the federal government. We're solidifying regulatory structures in the states. So New York, New Jersey, California, Illinois, New Mexico, Colorado. We're looking to work with state legislators and state banking regulators to recognize the value of online lenders and create the balance that you need to provide the access to credit without hurting consumers. And then so on and so forth down the line as you think about payments companies and sort of the challenges they're going to face. And so there are obviously regulatory priorities that we have, but the idea is to build the future of financial services and the regulatory structure that surrounds it, with a focus on industry and consumer.
So next question comes from Tommy. What role do you see FinTech playing in addressing the needs of unbanked and underbanked populations? And how can we assure that these services are accessible to all?
That's again, going back to what I talked about, these are great questions, so thank you for this. This is truly amazing. Going back to what I said about the Paycheck Protection Program earlier, FinTech is a great equalizer. It's not a perfect system. We'll be very clear about that as we As algorithms evolve and you think about alternative data, right? ChatGPT, and how is that used in underwriting criteria? Those are all things we need to be mindful of and be careful. As I said, we need to be mindful of the evolving ecosystem. However, our ability to use alternative data to underwrite, credit, as an example, provides inherently more optionality. So what do I mean by that? Think about what a FICO score is. Right? Traditionally, we rely on FICO scores to determine whether you are credit worthy or not. So think about what a FICO credit score is. If any of you have ever given this thought, FICO is a snapshot of your past. Okay? Meaning, if you had a job and everything was great, but all of a sudden you came on hard times or the pandemic hit and you lost your job and you fell behind on your bills, your credit score today, a year out of the pandemic, is probably not very good because you fell behind on bills. And so let's pretend that you have a bad credit score. Your ability to get credit is limited by what the last 2 years of your financial, or 3 years or 4 years or 5 years, the last 3, 4, 5 years of your financial history look like. That determines your ability to get credit or access financial services today. Now, let's take that same person who just landed the job of their dreams, right? That's going to pay them more money than they ever made. And so that person now has a great job. They have a great job, they have a stable foundation, but their last 5 years have been awful because they were out of work. The beauty of technology is that I don't have to look at a snapshot of your past, but I'm able to look at you in real time to determine what your future looks like. And this comes back down to your ability to repay, right? Remember what credit is we're taking a look at your risk profile and we're judging your risk profile. How do we price that risk? If I'm looking to your past, of course, I'm going to see all the bad shit that you did and you have an awful credit score. If I look at you today and you could show me whether it's a pay stub or whatever it is, the proof that you have a good job paying you a good salary, you're no longer a bad credit risk to me, right? You're a good credit risk to me. And I'm able to recognize nuances. As an example, you paid your rent on time, right? Historically, many things weren't calculated into how you judge credit. Today, we're able to look at a fuller picture of everybody's profile. And so when you think about the underbanked, the unbanked or the underbanked, that's exactly what FinTech is able to do. Now, we're not solving the problem, but today, FinTech, and we'll use online lending as easiest to understand. Online lending is solving the problems created with bank interest rates. As I mentioned earlier, community banks are closing at the fastest pace, fastest clip in history. And so what do you do when you don't have a bank branch to go into? You look to safe, secure, reliable online lenders who can fill that gap. And today, you're seeing that more and more in minority and rural communities all across the country, accessing credit, accessing financial services through FinTech, through FinTech channels versus traditional community banks. And there's studies that prove it time and time again. Like I said, you just want to make sure that you're utilizing, as this evolves, you're focusing on, transparent, responsible FinTech companies. Not all FinTech companies are created equal. And you have to recognize that there are some who are going to look to take advantage of you. But ultimately, FinTech is a great equalizer. As we proved, and it was proved during PPP, it democratized the system for everybody. Because once upon a time, you have to be a wealthy business owner to have a personal banker. Today, by virtue of the fact that you have a phone, you have a personal banker 24/7. Now just make sure it's the right one and the right company and you're transacting responsible.
Yeah. So the next question comes from Michael. Can you share some examples of transformative banking and insurance moderation legislation that you authorized during your time in the New York State Assembly?
On the banking front?
Yes.
Yeah. Okay. So when I was in the legislature, fortunate or unfortunate, I guess it really depends on how you think about it. I represented an area of southern Queens that was completely surrounded by water. I got elected in September of 2011. In October of 2012, Sandy devastated my community. About 85% of the people that I represent, 85% of my constituents their homes were either flooded or burned out. And so when you think about sort of what the recovery looks like and the rebuilding looks like, you oftentimes don't, you'll think about insurance, right? Because like, oh my God, am I going to get covered by my insurance? I have flood insurance, I have fire insurance, house covered, am I going to get protected? Am I going to get to rebuild my home? For me, am I going to get to rebuild this community? But what follows insurance, and what most people don't know, is that in order to cash your insurance check, because most of us have mortgages, and when you have a mortgage, it really means you don't own your house. The bank owns your house. You're paying off the bank to get your house, but the bank owns. When you get an insurance check is not made out to you. Insurance check is made out to the bank. So how do you actually cash that check? Everybody who would have ever thought to even know this, right? Because you should never know this. Anybody watching this should never know from this stuff. You should never have these kinds of problems. But all of a sudden, insurance adjusters came to people's homes, and they knocked on people's doors, and they examined their house. And yes, you're eligible for $190,000. Now, again, you're lucky if it was that simple. It was much more complicated than that. But ultimately, if you all agree you're eligible for $190,000 to rebuild your house, no problem. We're going to send you a check, and you don't get the check. And you think to yourself, well, where is my check? How come I haven't gotten it yet? And you're calling and you can't get any answers. And so finally, you realize your check was sent to, let's pretend it was a Main Street bank, right? Let's pretend Chase held your mortgage. That's the easiest example, because sometimes mortgages are held by banks anywhere in the country. Who knows who's holding your mortgage? And so let's assume your mortgage is the check got sent to Chase. Okay, so now I'm here. Like, who do I call? So I go to my branch, like, who has my check, and how do I get that money? Because I have a contractor ready to start rebuilding my house. How do I do that? And it was a challenge. Every single bank had a different process for how to make that money accessible. Now, from the bank's perspective, they didn't want people thinking that money is walking away, right? Because the bank owns that house, right? And if people take money and walk away, the bank is essentially out that house. And so every single bank was different. Some of them, and I will praise them today, some of them were great and said, here's your money. Like, we don't want to stand in the way of your rebuilding. And there was risk in that, but I think those are certain sort of risks you take when you're dealing with customers and consumers who are in a really bad situation. And some bank says, look, we want to do an inspection of your house also and see how much you're doing and set up an approach to start paying you back. And so I looked at New York State and I looked at our laws, and I started to introduce laws. And by the way, sometimes you introduce laws because you want to pass laws, and sometimes you introduce laws because you want to support the industry. And I started introducing a bunch of banking regulatory laws that were going to prohibit banks from operating in New York if they didn't start treating consumers differently. So I started creating some of the best bills I ever drafted or never passed, right? But it ultimately solved the problem that I was dealing with at the moment, that banks were refusing to give money to consumers. And what they told consumers was go find the money elsewhere. Once the house is rebuilt, we'll examine it and we'll reimburse the money. And so we wanted to flip that on its head. And people should get their money. And so if I recall correctly, again, in Chase as an example, I think Chase set up a 3-tranche system. We'll give you a third of your money right now to start construction. We'll examine if you're doing construction, we'll give you a second, and once your house is finished, we'll give you the third half. And again, different banks took on different structures for how they're going to disperse that money. But sort of post Sandy, this was just on the banking side, right? There's a tremendous amount of laws that we ultimately did pass to regulate the insurance industry. Equally, companies were taking advantage of consumers on the insurance side. But that was probably my first introduction to, again, it wasn't fintech at the time because fintech wasn't a thing, at least it wasn't a thing to me. But banks need to operate differently, right? The old traditional way that your community banker who lives down the block or who lives at that branch on the corner doesn't exist. Even in 2011, 2012, it didn't really exist anymore, right? People didn't know who their banker was. And so how do I call up this big bank holding my mortgage and get my money? And so finding ways to hold banks and traditional banks accountable. And that's kind of where fintech comes in, because we've changed the way in which we view processes that we do it that way because we've always done that way. Fintech is sort of interrupted that. And then you can see it already taking shape with buy now, pay later, influencing the credit card industry. The way in which, again, we look at and examine mortgages, right? You can go to Rocket Mortgage today and get a mortgage in probably a couple hours, or historically, it could be months before you had information that today you can have it in 10 minutes. It doesn't mean that's the right answer, by the way, but there are innovations that are enabling different systems, and the microfinance system to do that.
Yeah. All right, we have time for two more questions here. Get the second to last one here. It is from Amber. How do you think fintech companies can better collaborate with traditional financial institutions to create a more inclusive and equitable financial ecosystem?
I would turn the question on its head. I mean, how do traditional financial institutions work with fintech companies to create a more equitable financial system? I think traditional financial institutions, and I can probably get in trouble for saying this, don't want to see that innovation, right? They want to do it the way they've been doing it. They've been making money for 200 years, the exact way they do it. And every time you introduce innovation, somebody potentially is at a risk of stealing market share. Get the name of the book, and I was just reading it. Sort of the innovation in the 1950s when credit cards sort of came into existence. The question was like, safe should be using credit cards. And by the way, a lot of people said no, right? There's no good way to do it. And that's kind of where we are today in fintech innovation. Community banks, as I mentioned earlier, community banks that don't innovate are not going to be around in 5 years from now. Not because, there's some tech company that's going to knock them out. It's because they're not serving the consumers where they are. And the idea that people still want to interact with a banker or interact with a branch is slowly going away. And that's why you're seeing the consolidation. Does that mean that all community banks are going to disappear now? I think there's going to be a continuing evolution, and you're going to walk away, whereas today there's like 4,800, 4,700 community banks in the country. You'll end up where there's maybe 1,200, 1,500 banks, and then you're finding a lot more of the cross rivers where the banks that innovated and created the technological advancements are the ones who are going to continue to thrive and grow. I think that the Goldmans, the Chases, the Banks of America, the Cities, the Wells Fargo need to embrace that. And going back to PPP as an example, whereas tiny little Cross River made as many loans as Bank of America. By the way, I say it that way to be nice, because I can just as easily say that Cross River made more money, made more loans than Citi, they made more loans than Wells Fargo, they made more loans than Chase, they made more loans than every other bank in the country with 150 people. And so you want to know who has to learn from who? It's the big banks that need to learn from the technology innovators, the good ones, the safe ones, to find ways to fix their systems to better serve their consumers and not just focus on their own pocket.
All right, time for the final question. It's actually going to come from me this time.
Okay.
So it's actually in two parts. I usually ask this question to all of our speakers to comment. The first part is basically, if you have to go back to your past self, what would be the one thing you want to tell your past self that you wish you would have done? And the second part, because I know on this call, we know a bunch of, just by knowing faces I have here, some freshmen, sophomores who do not know yet they want to go into finance, maybe go into fintech one day. What advice would you want to give to them in pursuing maybe going down to finance or fintech?
Good questions. So I mean, this is going to sound kind of cliche, but I live with no regrets, meaning I'm one of the lucky ones, and I say this, that I never worked a job because I had to work a job. Let me qualify that with, I didn't grow up with money, like I'm not wealthy by any stretch of the imagination. What I mean by that is I valued my happiness more than I valued my need for a paycheck. And so we're all going to spend, and for students, we're going to spend a lot of time in the career path and at the jobs that we choose. For those of you who are in school and feel the pressures of you have to go to law school, right? Your parents are pushing you have to go to law school, or you have to go to business school, or you have to go to medical school, right? You have to do this, or you have to do that. Oftentimes, the inertia tends to carry you. What starts in college will carry on in your life, meaning the idea that you are forced into a space or into a profession or to a career because of whatever external pressure, and then the inertia continues to carry you. You do it because like, oh, I know it, it's easier to stay. I equate it to a relationship, right? When you're dating someone for 3 years or 4 years, you're what we call pot committed. It's like, oh my God, if I break up, I'm gonna have to start all over again, right? So, oh, we'll make it work and we'll figure it out how to make this relationship. It's hard. The concept of breaking up is hard because you got to start all over again. And similar with professions, right? Like when you're in a profession and you built a career, you're starting to build a resume, the idea of making a hard right turn or a hard left turn to shift is very, very hard. Let me tell you something. When it is just as important to know when to take a job as it is to know when to leave a job. It's just as important to know what industry to get into and to know when to get out of it. And I'm a living, breathing proof of that, in that I was never shy about, number one, doing what I love. And so, as much as my mother wanted me to go to law school, I ended up, I got a job part-time working for the New York City Council, and I loved the idea of community service. So I stayed, right? And I didn't stay in the same job, right? I stayed there until I could learn or grow or excel anymore. And I took another job where I can grow more and learn more and different skills and grow and expand and continue to feel like I'm contributing, but I was happy with what I was doing. All the way up until I ultimately ran for public office. And now one would argue this is the pinnacle of my career. Right? I'm 30 years old, I'm serving in the state legislature. My pathway in public service is endless, right? I could be president one day, right? Like I'm on that career trajectory. And I decided that like it wasn't making me happy anymore. Now I know this is gonna be hard, especially for college students, to recognize like what is crazy. Yeah, it wasn't making me happy anymore. The passion for what I was doing, something felt like it was missing, and I wanted to do something else. And let's say whether it's my wife supporting me, or I was happy that my wife supported me, because many spouses maybe wouldn't be as supportive, but I made a hard left turn. And I decided to explore a career in financial technology and community banking. And it's taken me to where I am today, and up to my move 5 weeks ago, where a lot of people think like, wait, you're over 40 and you're making another career change, right? You're shifting to a different, I'd say it's not a different industry, but a different vertical within this industry. And the answer is yes, because I love what I do. And from the time I graduated college till I am today, I have always loved all the time that I've spent in my work. Now I spend a lot of time in my work, and so it's important that I love it. I would say the same thing to each one of you. Let's pretend for a second you're going to take a career in finance. You're going to work your asses off, right? You are going to grind, and if you come home at 10 o'clock at night and you are miserable, then what's it worth, right? The idea of like having so much money, but you're not enjoying all the money that you're making. Why not find the balance of both, right? The same thing of technology and regulation, right? You want to find a good balance. Same thing with your life. You want to find a good balance that enables you to love what you're doing, enjoy what you're doing, so you could feel good about, number one, what you're contributing, and number two is what you're getting out of it. So I encourage each of you to sort of not let the pressures determine and define what you do and how you do it. Figure out what drives you, and then let that come out. Because if you love what you do, by the way, and this is sort of the thing I'll end on, when you love what you're doing, you're going to do it well, right? And that is undeniable. When you love what you're doing, you bring a passion to it, and you bring just sort of a desire and enthusiasm to your work, even without trying, you're going to do it well because you love it. And I say that about every job that I ever had, and I say that about the job I have right now. I mean, I took a flight to Colorado last week. I was on the plane for 4 hours, and I was never so excited to write an op-ed and 2 press releases, right? Like it was just sort of this. It wasn't the op-ed and the press releases. It was the subject matter expert, the subject matter I was diving into, right? The regulatory structure in Colorado, the new federal regulation that we were pushing for and asking for. I loved it. I sat on the plane, and with a vigor and enthusiasm, I worked the entire time. Most people say you're crazy. Turn on a movie, go 2 hours, turn your brain off. The work, right? What the old cliche: if you love what you do, you never work a day in your life. It's a cliche to those people who never actually experienced it. It's not a cliche. It's God's honest truth, and I wish it for everybody. And I say it to my kids, and I say it to every student I ever talk to: is that you should find opportunities to love what you do. And think about it when you think about a class, right? Class that you're interested in, right? And so I'll use it, I don't know what they call them here, but core classes, right? Like you require X amount of classes you have to take. And so I remember back in college, I had to take sciences, right? I hated it. It's miserable, right? And by the way, I didn't do very well, right? Like, what's the reason? Think about the science behind that. Because when you hate something, you're not going to focus on it. You're not going to give it any attention. You're not going to study for those tests. and you're not gonna do well, right? Versus the class that you love. For me, it was political science. Loved political science. And I aced every political science class I ever took because I loved it. Same thing in life. Life doesn't change. And so when you think about what you're learning in college, it's not just about the classes you're taking, but it's about sort of the grander picture. And so take the opportunity to look at what your life is at 10,000 feet every now and again, and take yourself out of the muck, and you'll see a whole different view of yourself and of your experience.
Well, that is all great. Thank you. Thank you so much for coming to speak to us today, Phil.
My greatest pleasure.
All right, thank you so much.
Thank you, everybody.
Members, please say on after we go now. Yeah, that's it.
Turn it on.